Just as a bit of context, and I'm sure most of you are familiar with this, but it's worthwhile showing you in graphic form what happened. As you know, there was a giant crash in oil prices. We're going to talk about minerals in a second. Let's start with oil. So there was a giant crash in oil prices in March, or at the beginning of the year. That's partly, obviously, the COVID demand effects were the principal driver, but there was also, a lot of overproduction, and there were some supply issues and some storage issues, rather. So there was a lot of things going on, but as you can see, there was a huge 73% drop in the average price of oil globally at the beginning of the year, which has rebounded a little bit, but has sort of stabilized between $40 and $50 per barrel. We've seen other drops in oil prices that are similar in the past, but what is unusual about what just happened is the speed of the drop at a time when oil prices were not particularly high. You can see during the 2008-2009 financial crisis, you had a much bigger drop, but that was from an unusual high. So you had the 73% drop from a relatively recent or normal oil price. What's the price going to be going forward? There are lots of different projections. There's the Rystad case, there's the forward case, which is based on forward futures markets. There's the JP Morgan scenario, which is really an outlier. It's not too many other organizations agree with that future oil price. As you can see, sort of the consensus forecast, at least what the markets are telling us, is a $40 to $50 per barrel oil price through the next 5 years. That there might be volatility, it might go up and down, but there are a few things that are going to be driving this lower oil price. The biggest of which is the energy transition. There's a lot of research out there that's suggesting that peak oil demand has already occurred. So any sort of volatility in the price will be more supply based, and that's it. And you're going to have a pretty stagnant oil price going forward, which has pretty drastic implications for oil producing countries. In the very short term, in 2020, what you've seen because of the lower oil price are suspended projects, lower production, and what we call technological shut-ins. So what that means is there's certain places where if you shut off production on a given field, you can't ever go back to your previous production levels because of technological issues. There's some countries that won't experience a huge decrease in production. That's the Ecuador, Kuwait, Iraq, Algeria, Saudi Arabia. That's because they produce oil very cheaply already, so the lower oil price won't affect them very much. At the opposite extreme, you have Guyana and Mexico and Ghana, which have higher cost oil, and therefore there's going to be a pretty massive impact this year in terms of production. We're also going to be seeing, or you are seeing, cuts in development budgets and exploration budgets, delayed licensing rounds. So, how delayed these projects are depends a lot, or is going to depend a lot on the cost of production in different countries. What this chart shows you is the percentage of projects at risk at different oil prices. So at a very, very high price, you have the red and the orange. Those projects are at risk, but really what we really care about are those green and yellow spaces, which is the projects that are going to be put at risk at $40 to $60 per barrel. And essentially that means almost all of Ugandan oil, most of Senegal's oil is at risk, most of Guyana's oil is at risk of never being produced if oil prices stay at $40, $50 per barrel. let's move on. What is this? How does this translate into revenue or hydrocarbon revenue for governments? Huge drop in oil revenue in places like Venezuela and Ecuador. In Iraq, you see a more than 50% drop in hydrocarbon revenues, which is incredibly important there because more than 50% of the government budget is dependent on oil. In other places like Myanmar, you don't see a huge drop in revenues going to the government because they're mainly a gas producer and the price is locked in over the long run. So there's very little, the drop in the oil price won't have a huge impact on government revenues. Also, just as a reminder to everybody, if you have comments or questions while I'm talking, please feel free to use the chat box, and I'd be happy to answer them while I'm talking. So moving to the mineral sector, mineral prices have already rebounded since the crisis. There were a few mineral prices like copper and zinc and aluminum, whose prices really dropped, in iron ore, for example. Prices really dropped in March and April, and almost all of them have rebounded completely. Actually, gold is reaching an all-time high. Nickel is completely rebounded, copper is completely rebounded, aluminum's rebounded. So the effect that we saw of lower commodity prices in countries like the DRC or Suriname, countries that are very dependent on mineral revenues, those impacts are, were very transitory, as you can see. The bigger impact is not from, in the mineral sector, is not from mineral prices, but it's more due to certain mines being suspended due to COVID outbreaks at the mines. So, so far, at least 268 mines have been temporarily suspended. Some of them are already back online, but you can see a list of some of the mines that were suspended for some time. Antamina, which is a huge mine in Peru. You have a uranium mine in Canada. You've got some South African mines. So in each of these places, for health reasons, the mines suspended operations. And the big risk for a lot of countries going forward is going to be whether really important mines in different countries are going to be suspended in the future because of future COVID outbreaks. So we'll have to watch that carefully. Okay, so let's talk now a little bit about the impacts on policy. And again, I'll take maybe 10-15 minutes to talk about these. There were lots of different things I could have spoken about. I could have talked about the impacts on licensing. I could have talked about the impact on fiscal terms and tax collection or state-owned enterprises. What I've decided to do is talk about 3 issues because we have limited time, and it's maybe the issues that I'd like supreme audit institutions to think about the most. And the 3 risks I'd like to talk about are tax breaks for oil and mining companies, overinvestment by state-owned oil and mining companies, and macroeconomic crises. So let's start by talking about tax breaks. And I'm just going to stop for a second, make sure everything's okay. There are no questions or comments right now. I see something in the chat box. Okay. Okay, if there's nothing, then I'm going to continue. So, let's talk about taxes. There's already been a lot of pressure being put on governments in many countries, especially low and middle income countries, to cut taxes, especially for oil companies. And what oil companies are essentially saying is our profits are being hit. We'll have to close down operations unless you give us a tax break. And what I want to tell you is that in 99% of those cases, operating projects do not need a tax break. Most of them are still operating at a profit, and you can see from this chart the operating costs per barrel in a number of countries, except in very high producing countries like Trinidad and Malaysia. Projects are going to continue operating even under this, in this low price environment, excuse me. So there's really no reason to give a tax break. And those projects that are maybe losing money or continue to produce at a loss during these low prices have essentially two options. First, they can think about whether these low prices are permanent, in which case they'll have to shut down. Or if they're temporary, then their companies are prepared to expect a loss for a small number of a few months or a couple of years until they go back to profitability. So there's very little justification for providing tax incentives to operating projects. But let's talk about projects that are not operating yet. There are a lot of projects out there that are in development or may come online soon. As you may know, I don't know if you've already discussed this amongst yourselves, but Guyana, for example, is about to become a massive oil producer and has just started production. Suriname, same thing. There are new fields in Senegal that are potentially going to come online. In Ghana, the 10 field in Ghana, a lot in the Middle East. So the question is, should governments be giving tax breaks in these cases? The answer depends a lot on the individual project. So what this chart shows you is the cost of production for different projects in Algeria. And I just picked Algeria. I could have picked any country. Algeria just had interesting data, so that's what I picked. As you can see, there's certain projects that would be unviable even at $75 per barrel, right? The project's on the right side of the screen. On the other hand, some big projects like the AT project on the left side of your screen are viable at below $25 per barrel. There are very, very, very few projects that need tax incentives in order to become viable. And essentially in Algeria, there's only one. There's this, it's marked as 438B, El Mzaid, I think that's the way you pronounce it. And that one is a marginal project, until, unless a tax incentive is given. But what I want to show in this is, again, either projects are unviable even at higher prices, or they don't need tax incentives in order to be developed. Whether countries should be giving tax incentives obviously depends a lot on the cost of projects in your country. Each country has a very different break-even price for its oil projects. Some, like I said, like Ecuador or Peru have relatively high break-even prices. Kazakhstan, Saudi Arabia, Venezuela, and Norway have relatively cheap oil. So again, you don't need to give tax incentives in those countries. Going forward, and this is one of the things I want to highlight for everybody is even oil companies are preparing for the post-oil world. BP is now selling itself no longer as an oil company, but as an energy company that focuses on renewables as well. And a lot of this, how different companies are responding to the low oil prices depends a lot on what they assume future oil prices will be. And as you can see from this chart, oil companies are, generally assuming a fairly low price, $40 per barrel, except for a few companies, but below $40 a barrel over this year and next year. And there's some companies that don't see the price of oil, going back up above $50 or $60 per barrel, maybe ever. And again, that has to do with the energy transition, and it also has to do with the shale oil revolution in the United States. Essentially, if the price goes up too high, a lot of American companies can bring shale oil online very quickly, which would then depress the price. So again, oil prices are not ever expected to go back up to the crazy $100 or $140 a barrel that we saw a decade ago. All right. So what are the three takeaways on oil and gas sector policy? First, low-cost producers will still produce, so it's important to maximize revenues and minimize tax erosion and avoidance, and I think size have a really important role in this. Number two, low taxes are not necessary to encourage new production and may cause governments to lose out if prices rise in the future. So the best thing that a government can do is put in place a progressive tax, like a resource rent tax or a sliding scale royalty, rather than constantly renegotiating contracts. And three, the energy transition is underway. So one of the things I think, again, an interesting role for size, or at least in certain countries, would be to encourage better investment in renewables rather than more oil and gas production. Okay, I'm going to move on to my next topic. Again, I want to see if anybody has any comments or questions. So somebody asked a question.
Yes.
Here we go. What have been the experiences with oil companies evoking hardship vis-a-vis major clauses to investors take contracts under these conditions? So what's interesting is you're just starting to see projects in certain countries being delayed, and what's called force majeure being used in contracts. Essentially, something happened that's outside of our control. We can't fulfill our obligations in the contract. We've seen that in the mining sector in Zambia. We've seen, again, I might be mistaking this, but I believe force majeure is being considered in the for the 10 field in Ghana. So we already are seeing companies invoking these clauses. I can send you that. There's a very interesting article on that. So to Ed, I'm going to send you to a really interesting article that covers exactly this topic that you can learn more about. But yes, companies are already starting to invoke clauses to sort of get out of contracts. And then Keto Kayemba asked, what does the renewables landscape look like? There's a lot to say on that. Keto, I'm going to ask, I'll answer that question at the end of the presentation because there's a lot to say on renewables. It's let me just put it this way. When all other stocks on the stock market crashed, renewable energy companies still did well. And that tells you, I think, a lot about at least the way the market is viewing renewables. That's the future. So, but we'll let me come back. Oh, we have a hand up from Anthony Kimuli. Please go ahead.
Okay. Thank you, Andrew. You hearing me?
Yes, we hear you. Go ahead, please.
Yes. When I look at your statistics, you've shown the prices of oil going down. I saw Uganda is one of the risk. You said at-risk resources. Ghana, where you're saying that even with at 40 and 60, Ghana, I think you're still, there's no break even. Then, of course, I saw you're saying the energy transition is also coming in, the renewables have come in. But I'm seeing a lot of interest by some of these major oil companies. An example, like Total for the last 1 or 2 years, even with the low prices last year and with this with this outlook you're showing. They're showing aggressiveness. They're coming in. They're still getting new projects. Like recently, we had in Uganda, we had one of the big. They have signed the East African crude oil pipeline, which is coming from Uganda going through Tanzania. They have just signed it, I think, last week. Is there something that they are seeing? It appears they are, for them, they are positive. They're positive thinking. But I'm seeing what you're giving the statistics look a bit dim. What is happening?
Well, that's a very complicated question, and each project is different. So if we're talking about the Uganda case, I can talk about that, but maybe just a couple of general points, and then maybe Anthony, we can talk a little bit at the end of the whole thing about specific cases like Uganda. The first thing is, I mean, we have to differentiate between projects that are already where there's a lot of infrastructure that's already been invested versus new projects, right? Where you already have a lot of essentially sunk cost. You have billions of dollars put into pipelines or project development or whatever it may be. Companies obviously they want to get a return on that, so they're going to want to produce no matter what. The projects that are most at risk are the ones that have where there's very little investment that's already been put in. So this is again, like in Senegal, some Guyana projects, but you're right to say that there's still interest from oil companies, and the reason for that is that they need to demonstrate to their shareholders that they're constantly adding to their reserve count. I think the statistic was that oil companies around the world need to add 3 billion barrels to their reserves every year just to maintain current reserve levels, because that's basically that drives a lot of their share price. So companies are going to want to get rights to your oil. It doesn't necessarily mean they want to produce it. They'll only want to produce it if prices go up. And like I said, oil companies are, there's some that believe that oil prices will be high again, but I'd say the big ones generally realize they will never be that high again. So I don't know if that answers your question, but it's a very, very interesting. I mean, there's just a lot more to say on that. Edmund has a hand up. Please go ahead.
Yeah, I mean, thank you, Andrew, for your response on my earlier question on hardship clauses and so forth. I mean, I have a follow-up to that. I mean, you've been very bold and you've given us sort of like some intel on how to respond as far as taxation is concerned in this scenario. Now, let's look at these hardship clauses that are being invoked. In your view, do you think they are justified? Do you think they are valid, or it's just a simple case of the companies trying to run away from their obligations and using, of course, COVID-19 to pull a wall over us?
Yeah, so I think each case is different. I can't speak to a specific case because, first of all, I don't want to be sued by the company. But I can talk in general, and I think in general, my experience is at least during COVID is the latter, right? It's exactly that. No, they do not have a good case. In most countries, companies do not have a case to renegotiate, especially tax regimes or fiscal regimes, because of COVID. But they are using these clauses to either delay projects and hope that prices go back up, or for other reasons. So very, very much the latter. That's my general answer, but again, I'm not going to talk about specific cases. The article does speak about specific cases though, so I'll let the article speak for itself. All right, so let's continue and talk a little bit about state-owned enterprises and macroeconomics, and then that'll be the end of my presentation, and we can talk a little bit more about these issues. Okay, so the second risk I want to talk about is state-owned enterprise overinvestment. This is an issue that I think doesn't get enough attention in almost every country. There are very few countries that do not have a state-owned oil or mining company. And in the majority of cases, these companies spend a lot of money outside the normal budget process. They might employ a lot of people. They might have tax collection responsibilities. And in many, many, many cases, they're not necessarily doing a fantastic job. So I think this is an issue, or these are institutions that size, I think, have a really important role in improving their performance. So just a couple of quick stats about them. There are more than 146 state-owned oil or mining companies globally, of which 1/3 are in the mining sector. There are many, many more than the 146, but most of them are in China. In China, at the provincial level and at the national level, they're just dozens and dozens of these companies. SOEs are often driven by what we call drill, collect, borrow, spend strategies. So essentially that means expand, 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 and spend and keep on growing bigger and bigger. And the reason that that's not necessarily always a good idea is because every dollar that is reinvested in a state-owned enterprise that's drilling for oil or mining is a dollar that's not being invested in education or healthcare or infrastructure. And so often governments see these things in silos. Oh, we have to have a strong national oil company, or we have to have a strong national mining company, but they don't see the trade-off, or the what we call the opportunity cost. That if you building up a national oil company or a national mining company sometimes means not building up your education sector, because you don't have money for both. And it's not necessarily the best investment. In some cases, it is a good investment. There are lots of successful state-owned enterprises that generate a lot of jobs and generate a lot of income for the government, but for us, but there are also many that do not. So I want to focus on both of those. This chart shows you just how big national oil companies are. NOC means National Oil Company. In countries like Azerbaijan and Venezuela, Malaysia, Kuwait, Thailand, Algeria, these companies, their gross revenues, are as big as the entire government budget, right? I mean, these are just massive, massive companies. One of the things that's interesting about them is that it's in less than 25% where governments transfer most of their, sorry, let me put it this way. Less than 25% of the revenues that are collected by them in general are transferred to the government treasury. So most of these state-owned enterprises, most of these national oil companies, they retain a lot of that revenue and they reinvest it, or they spend it. Or in some cases, like in Venezuela or in Angola, they are states within a state, right? There's the government budget that spends its money on education and healthcare and infrastructure, and then there's the national oil company that also has spending on education and healthcare and infrastructure. So you essentially have parallel governments. You have the government and you have the state-owned enterprise, and they're both doing similar things. Because we are talking about audits and supreme audit institutions, I want to talk a little bit about what type of audits can be done on state-owned enterprises, or audits that have been done in the past that have been very successful in recovering money. There's a really interesting case from Indonesia, and I think we have some Indonesians on the call today who can add details if you have details here. But there was an audit by PwC that showed that Pertamina, the national oil company, lost $6.1 billion between April 1996 and March 1998 due to embezzlement, illegal commissions, price markups, procurement contracts, et cetera, et cetera. For example, there was a 10-year lease for an oil tanker from PT Dwiputra, which was a joint venture between a Japanese company and one of the former President Suharto's sons. And Pertamina, the state-owned enterprise, was charged 36 to 40% more than the market rate. So keep in mind that's money straight out of taxpayers' pockets. So, but the good news here is that out of that audit, Parliament got involved, and there were more than 150 contracts that were canceled or retendered. So there's the story ends well. There was a lot of reform that was done in Pertamina. Another issue I want to talk about is the debts, these state-owned enterprises. Some of them are, borrow quite a lot, and in many cases, this borrowing is off budget, so it's not recorded in the national debt statistics. Guess what happens if these companies go bankrupt? It's the government that bails them out. It's the taxpayers that bail them out. So, one of the really good cases of this is Pemex in Mexico, which has accumulated pension obligations valued at $90 billion. And they haven't saved enough to actually cover those obligations. So that's 4 times the size of Exxon's pension liabilities. So in 2016, the Ministry of Finance had to assume $10.2 billion of these liabilities. Then they dumped another $4.2 billion into the government. And then in March of last year, they announced another $6 to $7 billion bailout. So poor governance at the state-owned enterprise led to, 25, or more than $25 billion in taxpayer money going to the state-owned enterprise. Again, this is not millions of dollars, this is billions. If this doesn't draw people's attention, I don't know what would. So my takeaways for state-owned enterprise policy are the COVID-19 crisis has highlighted these vulnerabilities, that SOE audits should be a priority in most resource-rich countries, and that the SOE audits could focus on high costs coming from, say, weak procurement, over-indebtedness, quasi-fiscal expenditures, could focus on low revenues, inefficient revenue retention rules, essentially too much money staying with the companies, or excessive liabilities. Again, this debt issue I was talking about. Okay. Now, the last issue, I only have, I think, 3 slides left. And then I'll come to the to Keto's question on Uganda. I'll come to that in a second. Let me just do these last 3 slides, and then I'll open it up to questions and comments. And then the last risk or impact of COVID-19 has been on the macroeconomy. There are a number of countries that planned well for crises. Countries like Australia and Bolivia, Botswana, Chile, Kazakhstan, you can see the list there on the slide. South Africa, Tanzania have lots of fiscal space to spend. Not all of them, like in Tanzania, that fiscal space is not being used, but they have the fiscal space, which means that they have low debt levels or high savings so that the country can get through the crisis without making major cuts to public spending. At the opposite extreme, you have a number of countries that enter the crisis having already overborrowed, or they don't have savings. They used to have, say, sovereign wealth funds. Like in the Algeria case, they used to have a sovereign wealth fund, but they spent all that money before the crisis. Same thing in Venezuela. They had a sovereign wealth fund, but they spent all that money before the crisis. So these countries are arguably facing debt crises today. Algeria, Angola, the 2 Congos, Ecuador, Eritrea, Mozambique, Iran, Nigeria, Suriname, Venezuela, Zambia are all countries that where debt crises are underway or are likely in the near future. So what does that mean for, well, let me talk a little bit about how countries have responded to COVID. and then what this means for size. So in countries where they don't have any more fiscal space, they've overborrowed, they've spent all their savings, like in Algeria, Venezuela, essentially they have to make brutal cuts, and social services are being cut, infrastructure is being cut, everything's being cut. On the other hand, there's some countries that are using the crisis to do things that they've been wanting to do for years, but haven't had the political courage or political ability to do so. So like cut fuel subsidies. And Nigeria, Libya, Tunisia, Venezuela are all cutting fuel subsidies. Dubai and Sudan might do so soon. A lot of countries put in place fiscal stimulus. We can talk about that for ages. Tax cuts, lines of credit, cash transfers for people. Again, in order to be able to do that, these countries need to either be able to borrow or they need to be able to draw down on their savings. So there's some countries that have drawn down on their savings, like in Botswana or Chile or Peru, Russia, Saudi Arabia. A whole other set of countries have borrowed a lot, like at DRC or Guyana or Mongolia, Nigeria. And then there are a lot of countries that have borrowed, but from their central bank. So this is what we call debt monetization. It's essentially printing money in order to pay for public services. And we can, again, talk about the advantages and disadvantages of that. But like Bolivia, again, DRC, Ghana, Guyana, Iraq, Myanmar have all done that. And then there's some countries that have actually increased taxes at this time, again, because they've been wanting to do that for many years. All right. My last slide is this. What does all this mean for size? One of the things that the head of the IMF said recently, which I really liked, she said, spend now, but keep the receipts. So there's a lot of spending happening in many countries because of COVID. That spending is important. It's keeping people alive in this really tough time. But what's really important is that size should be able to, in subsequent years, go back and ask the government for all the receipts and how they spent that money, and to do audits on all this emergency spending that's happening right now. Size could also be monitoring debt challenges and restructurings and debt restructuring to ensure that they're carried out fairly. And of course, size could encourage economic diversification, expanding the tax base, reducing fuel subsidies, reforming public financial management. And the reason I think this is really important for them to do is, as you can see, the countries that had fiscal space, that kept debt levels low, where they had a lot of savings going into the crisis, are the ones that are doing the best today, that are going to be doing the best in the future, that keep their jobs, keep their economies going, and aren't suffering as much as the ones that did not plan in advance. So planning in advance is really paying off today. I'm going to stop there.